markets reward specification over prediction. The moment capital is placed at risk, the trader faces three bedrock truths that do not change. Capital is finite, distributions are uncertain, and costs pull on every decision like gravity. Finite capital means survival is the first requirement, and all plans must honor that boundary before discussing return. Uncertain distributions mean no single outcome validates or invalidates a method, and that sequences will cluster in ways that feel non-random. Costs act as constant drag and include spread, slippage, commissions, financing, platform delays, and the cognitive cost of attention. Against these fixed conditions, the trader only controls three levers in real time. Exposure describes how much risk is engaged. Selection describes which opportunities are taken and which are passed. And behavior describes how faithfully a plan is executed while under stress. First principles thinking for trading begins with these primitives and rebuilds the operating model from them with no reliance on tradition, folklore, or identity. It asks what must be true for an edge to exist, what must be measured for the edge to be real, and what must be done to keep the edge intact long enough for math to express. Under this approach, confidence is not a feeling and not a trait. Confidence becomes a property of process because each action is grounded in observable conditions, and each condition maps to a rule that can be tested, enforced, and audited. The aim is to transform prediction into specification. Prediction is a statement about a future price path. Specification is a statement about present state, boundaries, and actions that follow if and only if the defined state is true. The specification does not need to be right about direction to protect capital because it binds action to risk controls first and potential reward second. The core object of this method is the edge sentence. The edge sentence is a single plain statement that defines what the trader believes will yield a positive average outcome per unit of risk over a large sample. It couples a claim about a repeatable pattern or condition with explicit entries, explicit exits, and explicit risk caps. It is short enough to remember under stress and strict enough to be falsifiable by data. A valid edge sentence has four properties. It states the condition in observable language. It names the gateway that authorizes entry. It defines the invalidation boundary and the exit logic. It binds the whole to a fixed risk unit and a session level cap, so the size of any one error cannot threaten the account. The definition of edge under first principles is therefore precise. An edge is a one-sentence claim paired with operational rules for entries, exits, and risk caps that delivers a positive average outcome per unit of risk over a large number of independent trials. The phrase per unit of risk is intentional because it normalizes all outcomes to the same denominator. A risk unit is the fixed amount of capital that can be lost when a trade is invalidated according to plan. Fixing this unit turns every result into a multiple of that unit and allows outcomes to be compared across instruments and regimes. The risk unit is set first and is not negotiated by conviction. The account also carries a daily risk cap that limits total session loss to a small multiple of the unit. When the cap is reached, the operation stops for the day because the cost of degraded behavior rises sharply after loss escalation. Invalidation is the precise point at which the original premise is no longer true. It is defined either by distance, by duration, or by both. Distance invalidation uses a structural reference such as a swing high, a swing low, a session range edge, or a value area boundary, then adds a small buffer to avoid noise. Duration invalidation uses a clock and a reference time frame to state that, if expected, follow-through does not occur within a fixed number of bars or minutes. The premise is considered failed, even if price has not touched the distance boundary. These definitions remove discretion at the moment of stress and place it during design where choices are cheaper. Exits are engineered the same way. A distance-based exit closes the trade when price reaches a predefined multiple of the initial risk or reaches a structural target like a prior high. A structure-based exit closes when the market prints a defined condition that negates continuation. For example, a break and hold against the trade direction beyond a boundary that matters on the reference time frame. A time-based exit closes when opportunity cost becomes larger than the expected benefit of holding. For example, when the session moves into a low participation window or a scheduled event is imminent. The plan also defines boundaries that exist before any trade is even considered. Boundaries cover which instruments are authorized, which sessions are tradable, which time frames are used for reference and for execution, which setups are allowed, and what constitutes a valid absence of opportunity. The default state is flat, and this is not a passive idea. Default flat means the trader assumes no position and takes no risk unless and until the gateway condition is met with all required elements present. If a required element is missing, the action is pass, and a pass is recorded as a decision that preserved capital and attention. Under first principles, the act of passing is as operationally important as the act of entering because selection is a primary lever. This approach reframes the role of the trader from forecaster to operator. The operator builds a specification that binds behavior, reduces cognitive load, and protects against the two main failure modes, which are overexposure relative to capital and overprediction relative to evidence. Overexposure breaks the survival rule and must be forbidden by unit sizing and caps. Overprediction breaks the uncertainty rule and must be replaced by falsifiable conditions. The method, therefore, installs a chain of permissions that moves from environment to setup to present trigger to act. Environment in plan means market state fits the filter that historically allows the setup to express. Setup present means the preconditions exist, in full. Trigger fired means the discrete signal occurs that authorizes a single action. Act once means the trade is entered as specified, with no additions unless the plan defines a second gateway. Else pass means that if any link in the chain is missing, the correct action is no trade. By defining the chain, the trader reduces both hesitation and impulsivity because there is either permission or there is not. Under stress, the only in trade thinking that remains is monitoring. Monitoring tracks two lines: premise intact, holding by rule, or premise broken, exiting at the first valid moment. Monitoring does not invent new reasons to hold or new reasons to add. Monitoring checks distance to invalidation and time remaining on the clock relative to the rule and acts when either boundary is crossed. The approach is humble about costs. Spread and slippage are treated as gravity that must be planned around. The order path must be simple enough to execute without delay. The number of clicks is reduced. Chasing is avoided by requiring triggers that can be entered without stretching the stop or shrinking the target to a point that harms expectancy. The language of the plan replaces adjectives with thresholds. Strong becomes above a defined level. Weak becomes below a defined level. Soon becomes within a defined number of bars. Far becomes more than a defined multiple of the unit distance. This translation is essential because adjectives create room for stories, and thresholds create room for enforcement. Expectancy, not win rate, becomes the primary output metric, because a small positive average outcome per unit of risk over many trials is the only property that compounds reliably. The method views drawdown as a function of unit size and sequence variance, not as a referendum on identity, and it addresses drawdown with predefined actions, such as a temporary reduction of decisions or size until the edge reasserts in a clean execution sample. The promise of this video is simple and actionable. You will build an edge sentence that states what you do and why it pays on average. You will bind that sentence to a fixed risk unit, a clear invalidation, and exits that are defined before you act. You will define boundaries that make flat the default state, and you will replace prediction with specification at every step. You will learn to express a small advantage through large samples by reducing variance in behavior, by normalizing size, and by letting costs shape your tactics instead of denying them. In the next part, we will craft the edge sentence line by line, attach it to risk caps and decision caps, and design gateways and exits that are falsifiable and repeatable so that the plan can be tested, enforced, and improved only when the data justifies change. Begin by writing the edge sentence as a compact specification that can be read aloud in under 10 seconds and audited in a journal without interpretation. The construction sequence is simple and strict. Name the tradable condition in observable terms tied to a reference time frame. State the gateway that authorizes entry. State the invalidation boundary by distance, by duration, or both. State the exit logic using a category that can be measured, either distance-based, structure-based, or time-based. Bind the whole to a fixed risk unit and a session cap, and restrict the number of decisions allowed in the session, so fatigue cannot dilute discipline. A complete example of structure, without any narrative, looks like this when translated into neutral language. When condition A is true on the reference time frame and the gateway triggers on the execution time frame, take one entry only. Size set by distance to invalidation equal to one risk unit. Exit by the first applicable rule. Stop if invalidation is touched or time expires. Stop trading the session when total realized loss reaches the daily risk cap or when the decision cap is consumed. The reason the sentence must be 10 seconds or less is that speed under stress prevents reinterpretation. The reason it must exclude adjectives is that adjectives shift meaning under stress. Replace strong with above a defined level. Replace weak with below a defined level. Replace likely with minimum historical frequency. Replace soon with within a defined number of bars on the reference clock. Each replacement converts a soft descriptor into a threshold that can be checked quickly on a chart or tape without debate. Bind the sentence to a fixed risk unit before any market observation takes place. The risk unit is the maximum loss per trade allowed by plan when invalidation is respected. Choose a size that allows a long sequence of trials without threatening survival and never expand it inside a session because conviction is not a risk control. Tie the account to a daily risk cap expressed as a small multiple of the unit. For example, 2 or 3 units. And accept that reaching the cap ends operation for the day without exception. Add a decision cap that limits the number of trade decisions to a fixed count per session, not including passes. Decision count rather than time protects against the slow drift into low-quality trades near the end of a session. Together, the risk unit, daily risk cap, and decision cap form the containment shell that allows the edge to express across samples, even when sequences cluster unfavorably. Define invalidation as the first objective condition that proves the original premise is no longer true. Distance invalidation uses structural reference points and a measured buffer. A structural point is a swing extreme, a session high or low, a value area edge, a prior close, or another boundary that has historical meaning on the reference time frame. A buffer avoids noise and must be fixed in advance, either as a tick amount, a percentage, or a fraction of the average true range of the reference time frame. Duration invalidation uses a clock linked to the reference time frame. It states that, if expected, progress has not occurred within a specified number of bars or minutes. The premise is considered failed, even if price has not touched the distance boundary. Duration guards against capital being trapped in stagnant conditions and protects attention for better opportunities. Many valid plans use both forms. The distance protects against a direct violation, and the duration protects against decay. With invalidation set, engineer entries as gateways rather than guesses. A gateway is a discrete event that can be seen and acted upon without delay. It can be a test and rejection at a level, a break and hold beyond a boundary, a change of state in a measured variable, or a quote condition that indicates liquidity has shifted. The gateway lives on the execution timeframe, but must be aligned with the reference timeframe that defines the setup. The permission chain is enforced in a linear fashion. Environment in plan means the current regime matches what the setup requires. Setup present means the preconditions exist in full, not partially, not almost, but complete. Trigger fired means the gateway event has occurred exactly as defined. Act once means the order is placed as written with the specified stop and target, or with the specified exit logic, if not target-based. Else pass means no trade and a recorded pass, which is a credit to selection rather than a missed opportunity. This chain prevents the common error of inventing trades in the middle of incomplete conditions. Exits must be engineered with the same neutrality as entries. A distance-based exit closes the trade at a defined multiple of the initial risk, or at a defined pip or tick distance that has statistical support. It is simple to execute and easy to measure, but can leave money if the move extends. A structure-based exit closes when the market marks a specific structural change against the trade direction, such as a break in acceptance back into the prior range or a failure test that holds beyond the boundary on the reference timeframe. It adapts to conditions but must be defined tightly enough to avoid reinterpretation. A time-based exit closes after a defined clock event, such as the end of the active session, the start of a low participation window, or a fixed bar count that historically marks the end of edge expression. Time exits prevent decay and protect the decision cap for better opportunities. Falsifiability is the backbone of the entire design. A rule is falsifiable if a single observation can show it did not occur. If a rule cannot be falsified, it cannot be enforced. Translate every soft rule into a condition that could be failed by the next bar. Replace phrases like, momentum is strong with price is above level X, and the last Y bar's average true range is above value Z. Replace congested with range width on. The reference time frame is below a defined fraction of the recent average. Replace higher probability with minimum historical frequency measured across a defined sample size. These translations reduce cognitive load during operation and make post-trade review meaningful, because each outcome can be tagged by the rule that authorized it. In trade, thinking is replaced by monitoring, which is deliberately narrow. Monitoring tracks 2 operational lines and nothing else. Premise intact holding by rule means price and time remain within the boundaries defined by invalidation and exit logic. Premise broken, exiting at first valid moment means a boundary is crossed or the clock expires, and the operator executes the exit as the next permissible action, without delay and without seeking a better price. Monitoring reports distance to invalidation and time remaining on the clock. Monitoring does not adjust stops to avoid loss, does not add size outside pre-authorized pyramids, and does not invent new targets. To support monitoring, pre-build the order path so the platform can submit the stop and target or the stop and time rule as a bracket automatically, and verify that the stop will execute even if the platform disconnects. Keep the gateway simple enough that slippage does not destroy expectancy. Avoid entries that require chasing beyond the planned stop distance, because chasing compresses reward relative to risk and alters the falsifiability of the original plan. Tie sizing to distance to invalidation so that every trade risks the same unit. This normalization allows you to compare outcomes across instruments and conditions, and it prevents a single large loss from dominating a sample. Decide in advance whether partial exits exist. If partials exist, define the exact quantities and exact conditions that release them, such as a first scale at 1 unit of risk reached and a final release at structure break. If partials cannot be defined with this clarity, remove them to avoid erosion of expectancy by arbitrary scaling. The daily decision cap must sit alongside the daily risk cap and is enforced the same way. When the count is reached, Close the platform or switch to read-only mode. Decision count forces prioritization and keeps boredom from seeking action. Boredom is redirected into checklists, small mechanical drills, and note-taking that tighten language for the next session. When the edge sentence, risk unit, invalidation, and exits are written in threshold language and tied to caps and a permission chain, you have built a method that is both testable and operable. You can now run samples where each action is either authorized or not. Each entry has a single gateway. Each exit occurs for one of 3 reasons, and each failure points to either the rule or the execution. The goal is not a perfect rule, but a rule that is clear, falsifiable, and small enough to survive long enough for a slight advantage to manifest. In the next part, we will extend this into environment mapping, setup boundaries, triggers tied to complete order paths, normalization of size by distance to invalidation, the handling of spread and slippage as gravity, the removal or codification of partials, and the design of a pre-session ritual that sets the operator into a low-variance state before the first decision. Map the environment before you map a trade, and treat the reference time frame as the source of truth that defines regime, boundaries, and clock. Regime language must be observable and testable. Compressed means the reference range width over a fixed lookback is below a defined fraction of its recent average, and directional overlap is high. Expanded means range width is above the threshold and overlap is low. Orderly means bars progress with low intrabar, reversal count, and pullbacks hold within a measured depth. Erratic means reversal count is high, and pullbacks exceed the depth that typically preserves continuation. Liquid means average spread and top of book size meet minimums. Execution slippage is stable, and queued orders are filled within the expected delay window. Thin means spread widens beyond the set limit. Size vanishes at turns, and fill delay expands. Use the reference time frame to label the current state in these terms before any setup is considered, and accept that no setup is valid out of regime. With regime known, write setup boundaries so they can be enforced. Authorize instruments that meet cost and access standards. Authorize sessions where spread stays inside limits and participation is sufficient to move price. Anchor the setup on a single reference time frame and bind the execution time frame to it so context and trigger cannot drift. Bind a trading day clock with open, active, and low participation segments, so entry windows and time exits have a shared definition. Declare explicitly what absence of opportunity looks like. For example, compressed, erratic, thin, during a low participation segment, and record a pass when that state is present. Define the trigger as a discrete gateway tied to an already complete order path in the platform, so permission translates directly to action. A discrete gateway is a state change that can be recognized without interpretation and can be executed without modification. That can be a test and rejection at a level, a break and hold condition that remains intact for a fixed count, or a measurable switch in a variable that acts as a proxy for participation. The order path must be pre-built so that one action submits entry with protective stop and exit logic as a single bracket. And the protective stop exists on the server or exchange so platform failure does not convert defined risk into undefined risk. Reduce the number of clicks required to express a decision and assign a single hotkey or button to the standard path. Verify that the same path works for both directions and that stop distance calculates from the invalidation boundary rather than from a manual guess. Costs must be treated as gravity that shape tactics rather than as details ignored. Measure average spread and spread variance, and median slippage by order type and by time segment on the instruments you trade, and keep those figures in the operator manual. Avoid triggers that require chasing through the spread or that force entries at distances, that compress reward relative to risk below plan standards. Prefer gateway designs that allow placement at or near the defined stop distance, so expectancy remains intact after costs. When slippage makes stop orders consistently more expensive than planned, choose gateways that support limit entry with a fail-safe market out if the premise is broken, or stand aside during segments where slippage variance breaches your limit. Normalize size by distance to invalidation, so every trade risks the same unit regardless of instrument or regime. The sizing formula is mechanical. Calculate the stop distance from entry to invalidation, including buffer. Convert distance to currency using contract or lot value. Divide the risk unit by that figure. Round down to a tradable quantity that respects minimum increments, and do not override the result. This enforcement keeps loss distribution narrow, keeps behavior variance from bleeding into expectancy, and allows post-session analysis to compare like for like. Reduce concurrency when correlation rises. Correlation must be made explicit using a rolling measure on the reference timeframe or a practical proxy such as shared driver events or synchronized structure. If correlation exceeds your threshold, cut simultaneous positions, reduce per position unit size, or sequence decisions rather than stacking risk. The decision belongs in the plan and must not be invented mid-session. If partial exits exist, define them with exact triggers and exact quantities or remove them entirely. A precise definition looks like this when written into rules. Release a fixed fraction of size when price travels one risk unit from entry without violation, and move the protective stop to a defined point only if the rule states so. Release the remainder at a structure-based exit or a time exit that aligns with the clock. If you cannot state exact partial conditions in the round or lack one line and test them for expectancy erosion, do not use partials. Boredom is expected when selection quality is high and must be given a job, so it does not demand action. Build micro drills that can be executed during flat periods without opening the order ticket. Run a 10-bar replay to call regime labels out loud. Identify when the permission chain would have authorized a trade, and note where the first exit rule would have triggered. Practice the hotkey order path with paper size, so the movement is reflex. Tighten the operator manual by compressing long sentences into single lines that use your threshold language. Use a breath protocol to reset physiology before each potential decision. A simple pattern is slow nasal inhale to a comfortable count, brief hold, slow exhale that is longer than the inhale. Repeat for a fixed number of cycles to drop arousal. Keep this protocol short and identical every time, so it becomes part of the cue routine. Bind all of this to a pre-session ritual that sets the operator into a low-variance state before the first decision. The ritual is read and done in the same order every session. Read the edge sentence out loud. Read the risk unit, the daily risk cap, and the decision cap. Read the grit and ask an invalidation rule for the active setup and the exit categories that apply. Load the platform workspace that contains only authorized instruments, the reference and execution time frames, and the minimal overlays needed to see levels and clock. Run a quick platform check by submitting and canceling a test order in a non-tradable symbol or in SIM to confirm hotkeys and brackets work as expected. Survey scheduled events and mark the segments where operation is paused or size is reduced. Map the current regime on the reference timeframe in your threshold language and declare in plan or out of plan for the setup. Decide which single setup is active for the session and write pass on all others, so focus narrows. Write a one-line intention that ties behavior to process, such as follow the permission chain, risk one unit only, act once, else pass. Once the ritual is complete, the session begins and all decisions route through the same chain. During operation, monitoring remains narrow. Track distance to invalidation, time remaining on the clock, and whether a defined exit has become active. Record passes explicitly to reinforce selection as an action and to make opportunity cost visible in review. When cost conditions degrade, such as spread and slippage rising above limits, stand down and record the state as out of plan rather than forcing adaptation on the fly. When boredom returns, when run a short drill instead of seeking substandard entries. Close the platform or switch to read-only mode when the decision cap is reached, even if the risk cap is not, because decision quality falls under cognitive fatigue and the day's sample is complete. At session end, archive the regime label, the number of passes, the number of authorized triggers that did not fire, the number that fired and were taken, and the cost metrics observed. This creates the feedstock for review without requiring memory. In the next part, we will separate research from operation. Install review loops that classify adherence and deviation. Implement change control, so edits occur one at a time with evaluation windows. Define professionalism metrics for scaling. Build a minimal cockpit that supports execution. Set language for entry, hold, exit, and pause. And write policies for scheduled events and emergency halts. So, flatten first, diagnose, decide becomes automatic under stress. Separate research from operation as a hard boundary and protect both with schedules, tools, and language that prevent leakage. Research time is where hypotheses are formed, rules are written, as while, and data is audited. Operation time is where rules are executed without editing. During research, pull trade logs, cost metrics, and regime labels and compute expectancy per rule variant, normalized by the risk unit. Verify that every rule remains falsifiable and that each label used in the plan has a threshold definition that held in the last evaluation window. During operation, forbid any change to entry, exit, sizing, or environment filters. If a gap is discovered while live, annotate it for research time and route the current decision through the existing rule set or pass. Install a review loop that runs at defined intervals with stable scopes. A daily loop classifies each decision and pass for adherence and for deviation type. Adherence means the permission chain was followed. The entry gateway was present. The stop and exit logic were placed at specification, and the trade was managed according to invalidation and clock. Deviation types are standardized to remove moral language and allow clean counting. Pause compliance records, whether scheduled pauses for events or for thin segments, were honored. Boundary integrity records, whether stop distance and target or exit rules, were placed as written and left unchanged until a rule authorized movement. Delay and slippage records, whether activation, delays, or order choices, created adverse costs beyond the allowed window, and whether that was avoidable by plan. Valid passes and invalids avoided records, instances where the setup was out of regime or the permission chain failed and the operator remained flat, which is positive selection. Classification includes method applied and whether environment was in plan, so expectancy can be filtered by context. A weekly loop looks at aggregates. It reports adherence rate, deviation, counts per type, opportunity cost from valid signals passed, invalids avoided, spread and slippage drift relative to limits, and the distribution of outcomes per rule. The loop ends with one keep and one test. One keep is the single element that clearly supports expectancy and execution stability. One test is a single proposed change parked for research with a reason and a hypothesis. Change control governs how that test becomes a rule. Only one edit enters evaluation at a time. The edit is written as a compact statement that includes reason, hypothesis, and a measurable effect on expectancy, variance, or execution reliability. An evaluation window is defined in trades or in sessions large enough to produce a meaningful sample. Size is reduced during the window, and context is held invariant where possible. If the edit involves an entry gateway or exit logic, all other parameters remain frozen. If metrics improve and behavior variance does not rise, the change is retained and logged with a version stamp. If metrics degrade or adherence falls, revert without debate and log the result. Multiple edits are never layered because compounded changes hide cause and effect. Scaling follows a similar gate. Growth is allowed only when professionalism metrics qualify and not because a profit target was hit. Define the gate in advance with observable conditions, such as adherence above a set threshold over a fixed window, zero boundary integrity violations over the same window, delay and slippage inside limits, and drawdown contained within the expected band for the current unit size. When the gate is met, increase size by a small fixed step, such as a fraction of the unit or a small multiplier. Hold at that level for another full evaluation window, and step back one level if any professionalism metric degrades. Scaling uses unit-based thinking, so the psychological profile of losses remains stable. A minimal cockpit reduces noise and enforces sequence. Reference view comes first and execution view second. The reference view shows only the authorized instruments, the reference timeframe, session boundaries, and levels that define regime and structure. The execution view shows the trigger timeframe, the current gateway condition, and the order ticket with a pre-built bracket. Colors are neutral and contrasts are reserved for true boundaries, and the clock annotations are minimal and static. Do not display running profit and loss in and NS currency. If feedback is needed, in display results in multiples of the risk unit or hide scorekeeping entirely during operation and show it in review. The workspace contains only the instruments in plan and only the timeframes authorized for the active setup. Watch lists do not include out-of-plan markets. Notifications are limited to scheduled event alerts and platform status. The order ticket is placed where the hand naturally lands. Hotkeys or buttons are bound to the standard path and tested before every session. Micro-language compresses state into short lines that fit in the operator's head while under load. For entry, use gateway armed to mark a complete permission chain, waiting for the discrete trigger. Use act once to mark the commitment to place a single order at specification. For hold, use premise intact, holding by rule, to indicate the decision is governed by invalidation, distance, and clock, and not by feelings about unrealized result. For exit, use premise broken, exiting at first valid moment when distance or duration invalidation is reached, and use time exit now when the session clock or low participation window requires flat. For pause, use boundary. Pause when cost metrics or scheduled events put operation on hold. For boundaries, use out of plan flat when regime or costs violate setup filters. These lines become callouts in notes and replace narratives that are hard to audit. Policies for scheduled events are written in the same threshold language. Define which events pause operation outright and when the pause begins and ends relative to the published time. Define when size is reduced and by how much for lower tier events. For instruments driven by scheduled releases, write a no new positions window before and after the event, and route all exits to time-based rules that flatten before the event. If structure-based targets have not reached, treat earnings, central bank meetings, top-tier economic prints, and known liquidity handovers as structural features of the clock. Cost policy also includes spread and slippage limits by segment. If spread or slippage exceed the limit for a defined number of minutes, mark out of plan flat and proceed to drills. Emergency halt triggers cover conditions that create unacceptable execution risk or behavior drift. Platform instability includes disconnects, rejected orders, or abnormal delays. Cost shock includes spreads that double the limit or slippage that exceeds the allowed variance repeatedly within a short window. Behavioral drift includes moving a stop against the plan, adding size without a pre-authorized gateway, or failing to execute an exit on the first valid moment. Daily cap breach or decision cap breach also trigger a halt. The procedure is simple and always the same. Flatten first, so undefined risk cannot expand. Diagnose second by naming which trigger fired and whether it was platform, cost, behavior, or cap. Decide third whether the session ends or continues in reduced mode. Reduced mode defines lower size, lower decision cap, or a switch to read-only drills. Record one neutral line that states the trigger and the decision and add the event to the review loop. Do not allow debates about opportunity to override the halt, because halts exist to preserve the edge across the year, not the minute. Tie every part of this section back to versioning, so the plan has a current version in operation and a next version in research. The current version is a fixed specification that is executed without edits. The next version is the open test with its evaluation window and reduced size. At session open, declare which version is live and never merge them midstream. At session close, log outcomes by version so results remain comparable. The combination of review loops that would change control, scaling gates, a minimal cockpit, micro language, and event and emergency policies creates a stable operating envelope. Within that envelope, a small statistical edge can express because behavior variance is constrained, costs are acknowledged, and attention is focused on the few actions that matter. In the next part, we will finish by addressing causality versus proxy and how to update rules without chasing noise. Stress testing through cost shocks and regime shifts. Portability across instruments. Shadow operation before changes go live. A compact glossary that keeps language stable. Explicit correlation control with a Monte Carlo mindset for streaks. Opportunity cost tracking. A discipline ladder for recovery. Attention, budgeting. Ethics as edge preservation. A build list of invariants and a degraded mode for rough days. And an end-of-day synthesis, with one keep one test and one sentence for tomorrow, plus a clear call to share, and subscribe to flow state trading. Treat causality as the backbone and proxies as handles that make causality observable. Then update proxies, not causes, unless the causal claim fails across regimes and evaluation windows. A causal claim is the minimal statement about how price tends to realize when a structural condition is present and participation behaves within known limits. A proxy is the measurable stand-in that allows the platform to detect the condition quickly. If the claim is that acceptance beyond a boundary tends to continue until the next structural shelf, the proxies could be closes above the boundary for a fixed count, a measured reduction in overlap, and a stable spread below a limit. If proxies drift due to platform changes or microstructure shifts, retune the thresholds while the causal structure remains intact. Only replace the cause when forward observation and review show repeated failure across compressed and expanded regimes, orderly and erratic states, and liquid and thin conditions over a full evaluation window. Before any change reaches live operation, run simple stress tests that expose the plan to shocks and confirm degraded mode behavior, remains profitable or at least survivable. Double the typical spread in the calculation and verify the entry still authorizes with stop distance that preserves expectancy. Add a fixed slippage to exits and confirm that distance-based targets still beat costs on average. Expand volatility by measuring average, true range on the reference time frame at 1.5 times the prior window and show that duration invalidation protects attention from being trapped in whipsaw. Force whipsaw by alternating small range expansions and compressions and ensure structure-based exits and time exits. Fire as expected. The goal of stress tests is not to find comfort, but to produce a clear specification for degraded mode and a check that invariants hold when the environment is hostile. Portability across instruments or venues is allowed only when the causal structure is the same and the cost profile is similar. Same causal structure means the rule relies on features that exist in both markets, such as auction range edges, acceptance and rejection behavior, and participation cycles that map to the same clock. Similar cost profile means spread, slippage, and fill delay fall within the limits used to build the edge. If both conditions are present, forward, observe with trivial size while running the full permission chain and monitoring script. Record gateways that would have fired, record passes due to regime mismatch, and record theoretical outcomes in risk units. If the forward observation matches the source market with intolerances for expectancy and variance, graduate to shadow operation, where orders are staged and managed in real time with zero or near zero size. Only then allow live decisions at reduced unit size with an evaluation window and a revert rule if professionalism metrics degrade. Keep language stable with a compact glossary so labels do not drift under stress. Acceptance means price prints and closes beyond a defined boundary on the reference timeframe for a fixed count without returning inside more than a measured fraction of range. Distance means the number of ticks or the currency value between entry and invalidation, including the buffer written in the plan. Duration means the number of bars or minutes allowed, for the premise to show expected progress before a time exit becomes active. Extension magnitude means the measured move from the trigger to the next structural shelf or to the distance multiple used by the rule. Pullback depth means the retracement against the current move expressed as a fraction of the prior leg on the reference time frame. Clock means the defined session segments that sort into open, active, and low participation windows, and the scheduled events that interrupt the flow. Trend objective means a directional state defined by higher reference highs and higher reference lows, or the inverse without interpretation by adjectives. Sequence means the order of wins and losses inside an evaluation window, which is treated as random even when clusters appear. Hostile environment features mean compressed, erratic, thin states accompanied by elevated spread variance, unstable slippage, and event risk that violates pause policy. Correlation must be explicit rather than felt. Use a rolling correlation measure on the reference timeframe or a practical driver map for instruments that share events. When correlation exceeds your threshold, act by cutting concurrency, by reducing per position unit size, or by sequencing decisions so only one position is live at a time. If correlation spikes during operation, mark, boundary pause, and follow the emergency rule if positions are already open. A Monte Carlo mindset accepts clustered streaks and builds rules that are indifferent to sequence. Simulate samples using your true win rate and payoff ratio expressed in risk units and observe how often adverse runs occur. Set decision caps and daily risk caps that assume those runs will appear and that behavior must remain stable when they do. Never widen stops or tilt size to escape variance because that converts a statistical problem into a survival problem. Track opportunity cost as a first-class metric so the plan can improve selection without adding risk. Log valid triggers passed. Log invalids avoided by staying flat when the permission chain failed. And log partial confirmations refused when the rule required all elements present. Tag each pass with the reason and tag each avoided invalid with the element that failed. In review. And compare realized outcomes with the cost of passes that would have been valid and confirm that selection remains conservative enough to honor the decision cap without starving expectancy. Recovery from behavior drift uses a discipline ladder that is written in the plan and enforced automatically. After the first deviation, such as a moved stop or a late exit, pause immediately for one full cycle, defined as a fixed number of minutes or bars, and run the breath protocol plus a checklist read. After the second deviation in a session, reduce either size to half a unit or reduce allowed decisions by half. Then continue only if the permission chain fires a high-quality gateway inside plan. After the third deviation, end the session and write the neutral line that states the drift type and the end decision. The next session starts in reduced mode with a lower decision cap and lower unit size, and returns to normal only after a clean window with 0 deviations and full adherence to boundary integrity. Attention is limited by policy to protect execution quality. Limit the number of instruments to a small authorized list. Limit the number of time frames to a reference and a trigger view only. And limit the number of active setups to 1 per session. Limit rules by version, so only one tested specification runs at a time. If attention fragments, drop instruments first, then drop setups, and do not add visual overlays or alerts during operation. Ethics act as edge preservation rather than virtue signaling. The plan forbids moving stops away from invalidation, forbids adding size outside pre-authorized pyramids, forbids oversized positions relative to the risk unit, and forbids exceptions based on conviction or external commentary. Any violation is classified as behavior drift and triggers the latter and possibly an emergency halt. Invariants anchor the system, so changes do not destabilize operation. The invariants are the edge sentence, the fixed risk unit, the invalidation method by distance and duration, the realization method for exits, the environment filter with regime definitions, the change gate that allows one edit at a time, the unit tests that verify order, path, and cost limits, and the degraded mode that lowers size and raises conservatism when costs or behavior degrade. Build the plan around these and refuse edits that touch more than one invariant in a single evaluation window. End each day with a synthesis that closes the loop between operation and research. Compute professionalism metrics such as adherence rate, boundary integrity, delay and slippage relative to limits, decision, count inside cap, and correlation, control compliance. Write one, keep that you will carry forward without change because it supported expectancy and stability. Write one test that will enter the whirl, change gate with a clear reason and a hypothesis. Finish with one sentence for tomorrow that sets the operator in tension in threshold language. For example, follow the permission chain. Risk, 1 unit, act once, else pass. This framework converts prediction into specification, makes edge a compact sentence tied to risk, replaces adjectives with thresholds, and installs review and change control so a small advantage can express across many trials without being erased by cost or variance. If this approach brought clarity to your process and you want more straight-to-the-point systems that raise professionalism and protect capital, like this video, share it with a trader who needs a tighter plan, and subscribe to Flow State Trading for weekly frameworks you can execute. Da Hoan Dan.